Hey guys, this is Chris Mincola with the Mincola Group over at West USA Realty, and I'm doing our weekly market update. Wanted to update you guys on some exciting news and some predictions that we got from Barry Habib at MBS Highway, who we like to follow because he's typically going to be correct on the money, so to speak, and let you know where we are. We were looking at the target date of May 10th. Okay, now I'm going to explain to you where we are right now in the market first, and then I'm going to go into the details of, how things actually shook out on those predictions. So let's go ahead. I'm going to share my screen here right now with you. All righty. Hang on one second here. Let me get out of this. Maybe if I opened it first, there we go. Okay, let me pull it up and share that with you. Okay. Sorry about that. Okay, so looking at the news for this week and what's going on, everybody knows, everybody's here, hearing about the Feds raising the Fed's fund rate, which is not mortgage rates. I repeat, it is not mortgage rates. A lot of times people get confused with that. So what's important to know about that is basically it just what those basis points are is what it costs the bank, okay, to get money. Okay, what it costs the bank to get money, and that's why we see so many banks lately having issues or going under because of these interest rates, or these Fed's fund rates, I should say, going up. Okay, and that puts a stressor on them because maybe they bought when it was 0 or 2%, some of their mortgage backs, or their securities, their bonds, their treasuries, and they went ahead and now that they can't really unload these, so it causes a problem. It's like they bought at a good time, and then when you try and sell that off at a bad time, it's just not working out for these banks. So it's costing them more to borrow money, and therefore that cost eventually in a direct way will come to the consumer, whether it's in the way of restricting the amount of credit that's allowed, whether it's about how much it's going to cost you now to get a loan, a private loan, or a loan maybe on a vehicle, or whatever the case may be. So it's causing a stressor for everybody, including the banks. So this has a indirect effect on the housing market. Now, in a roundabout way, what they're trying to do is, in a direct way, I should say, what they're trying to do is they're trying to tame inflation. We had this inflation that's been going on for the last right around 3 years now, actually, and we see that in the last year it really hit ahead once they weren't basically buying all the mortgage-backed securities anymore and fixing those rates for mortgages to be at 3% or 2%, whatever they were. And last year in April, we saw this point where rates just jumped. So rates jump, and that April of last year is what brings us to this May 10th target date of this year in 2023, because the way the Fed looks at it is, where are we year over year on inflation? Are we up year over year, or are we down year over year each month? So April of 2022 versus April of 2023. And May 10th was when they made their announcements, and they're kind of where we were at, because all the information lags a month and a year behind. So what they're reporting in May is where we were in April, okay, of this year versus last year. Okay, so hopefully that makes sense. I've explained this many times, but I wanted to make sure we kind of explain that. And boiling it down, we were looking at what Barry Habib was saying, was that by once we get through April and we had the report on May 10th, we were going to see that year over year inflation had dropped. And a big part of that is shelter costs, okay, for rents and shelter costs. So that makes up 43% of in the inflation numbers that we're looking at. 43% of the inflation numbers that we're looking at. And then there's other things in there that I'll talk more about in a minute, and kind of put us where we are right now and where we're headed. So bottom line, they're saying the banking sector's fine. I think there's quite a bit of weaknesses there. I think if you dig a little bit deeper, and we already know the Fed is always late to the party, typically wrong. But what they're doing with taming inflation by raising those Fed's fund rates, I think has worked. It's whether you agree with the Federal Reserve or not, or you like them or not, for what they're trying to do, it's working. And they're always looking in the rearview mirror. They're always looking at lagging data. And of course, with rents, it is lagging data, right? Because, people sign a lease a year or two ago, and then you kind of have to catch up on where those shelter costs end up, for instance. Another big part of this is energy. Energy is about another, a little over 9% of the overall makeup of the, headline numbers of inflation. So that's a big part of it. And obviously everybody knows they're paying more for gas, which means if you're paying more for gas, it's costing you more. It's been inflated. It means that the trucker's paying more and the trucking company's paying more, which means that the foods and goods and services that need to be transported, those are all costing more, right? If that's the case. So that's another part of it. But bottom line, they also look at where we are on jobs, and we talk about this a lot too. And, the Bureau of Labor Statistics, the BLS, reported that there were 253 jobs created in April, which was much larger than estimates. However, substantive revisions to that data from February and March subtracted 149,000 jobs in those months combined, which tempered April's gains. The unemployment rate fell 3.5 to 3.4%. So what's the bottom line here? There's two reports within the jobs report, and there's a fundamental difference, they go on to say here in the article, between them. The business survey is where the headline job number comes from, and it's based on predominantly on modeling and estimations. And the household survey, where the unemployment rate comes from, is derived by calling households to see if they are employed. Okay. So you're calling people to see if they're employed, also, part of that with the shelter cost, they're calling people to survey them on what they think their home may rent for, or, what they're paying in rent, or what their home is worth on the rental market. And a lot of people wouldn't even know how to answer that. Okay. So this is how some of this stuff is baked in. And again, coming from MBS Highway, kind of an insider thing here, I'll just read this to you off this article. This is something aside. I'm just kind of reading off to the side here, but the BLS does every year go back and revise the numbers from the previous years. And in this case, they revised some of the earlier figures like April lower and revised some of the numbers at the end of the year higher. Because they revised the April lower, we are replacing a lower figure than originally thought, because the government can go in and change how they calculate things, and they do that all the time. Right? Because they revised the April lower, we are replacing a lower figure than originally thought. And it makes it harder to make progress with the new numbers for 2023. So now it's going to take a little bit longer to really see all this lagging data and the way it's been calculated. Pull your hair out, right? Why would he do that? I don't know. A lot of people speculate it's got to do with, maybe behind the scenes, there's some things going on with the Fed. A lot of people are saying the Fed is bankrupt or going bankrupt. Who knows? We're going into an election year. Who knows? But without getting political, who knows? There was also a spike up in oil in the first three quarters of April after OPEC announced production cuts. Remember that, which will be captured and add pressure higher. Okay. Bottom line, at the beginning of the year, we had our forecast for May 10th to be a turning point. This is from MBS Highway. But based on some of the changes, we think, and get government changes, right? Government changes in, energy sector, energy policy, going from energy dominance to not, okay? Just 3 or 4 years ago to not. And then we see with the way that they're calculating these BLS numbers for the employment and shelter costs, we've got a little bit of more of a lag in really seeing an impact. But we do have an impact, and I'll get into that in a minute. But based on some of the changes, we think it may be a little bit later in the year, okay, than May 10th, for a big difference in what we're seeing. It is still coming, and rates are going to move lower, but unfortunately, it may take a little more time. No one's perfect, and when some of the facts change, we have to make adjustments. When the government changes, okay, nobody likes politics, nobody likes to look at the government, but in the end, it does affect the way business is done and all these forecasts and people's jobs and your livelihoods, right? So it's good to have kind of a general working knowledge of this stuff, but it may take a little bit more time. Nobody's perfect. The facts change. We have to make some of the adjustments. I would explain that they shouldn't wait for, they say, don't wait for rates to come down. They will come down later this year. We're figuring that in the summer, we're going to see more of a decrease. Everything's trending in a decrease direction anyway for as far as mortgage rates are concerned. Okay. But right now you can still get a good price, as home prices have been gradually going up since January of this year. They bottomed out in the Phoenix market in December, and since then they've been going up. Since January, we've seen they've been going up. Biggest problem right now is inventory. There's just not enough inventory out there. And when we say new inventory, in reality, new inventory is really new home builders building new homes for new household formations, which we are behind on. The builders are behind on. Again, understandably, they're going to be a little bit squeamish with everything going on. But let's take a look at what's going on here with the modeling, and then I'll get into a little bit more where we are and why. We do have good news. It's just not as good as fast as we wanted. Okay. So with private payrolls, so we had issues with the modeling and all that, as far as the shelter costs and then the labor force. Okay. And one more thing here I will mention. It says, the household survey has its own job creation component, and it showed some underlying weakness with only 139,000 new jobs created last month. Plus, the labor force decreased by 43,000, which is not a positive sign. When we combine these two factors, the unemployment rate did decline, but not because of strong job growth. So, and again, the reason why we look at this is the Fed is trying to tame inflation. They do that by raising these Fed's fund rate, which means that it slows down business. It slows down, the idea is it slows down business. It slows down product development, company acquisitions. It slows down job growth then, in other words, okay? It slows down, tech development, everything, right? When everything costs more to borrow, because, most companies are borrowing money to survive. So when it costs this much more, if it's going to be a difference between 0% and a Fed's fund rate of borrowing at 5 or 6%, they might say, well, we can't do that right now. We can't afford to do that right now. We're going to wait. And we're going to even have to lay some people off or cut their hours. Okay. So that's just how they work the system, and that's what we're seeing right now. So what's really boosting private payrolls? Okay, private payrolls nearly doubled expectations last month. Again, trying to tame inflation, tame job growth, and tame all these things in the market in order to bring down spending, in order to bring down inflation. Whenever you go and get a car or buy something on credit, that money comes out of nowhere. Okay. And then basically that's an inflationary factor. They want to kind of tame all that to get to a point where it's calmed down and we go back to normal levels. For the Fed, would like to be back down, near, I guess at least 2, percent, not where we are now, over 5. So what's the bottom line? Leisure and hospitality sector once again led the way with 154,000 job gains, and in this sector has been a huge driver of job growth after massive losses seen during the height of the pandemic. However, these jobs may not bolster the overall private payroll total much longer. Okay. And it goes on to say in 2019, there were 16.2 million leisure hospitality employees, and now there's 16.25 million after last month's gains, meaning we have eclipsed where we're pre-COVID. So the point here is a lot of people, were, because of shutdowns or just the growth of things being slowed down during COVID, a lot of those people have come back and reemerged into the leisure and hospitality sectors. And now we've already surpassed that benchmark where we were pre-COVID already. So all those people come back. There aren't more coming back per se. So that's all been kind of, back to where it was. Private sector, it says private sector job growth has been quite volatile this year, with monthly gains averaging 205 January to April. This compared to the average 360,000 new jobs per month throughout last year. So we're seeing a clear slowdown, notwithstanding April's strong print. Okay. So so in other words, that's cresting. So that's going to be another lagging indicator once we get into the summer months, that's going to show up along with the shelter costs, and the payrolls, all the extra growth that we're seeing in the job sector. So we also saw the number of people filing for unemployment benefits for the first time rose by 13,000 in the latest week. Okay. Unemployment benefits after their initial claim is filed declined by 38,000 to 1.805 million. So its bottom line here is the jobless claims can be volatile from week to week, but they continue to trend higher. Okay. So that means they're destroying job growth, destroying inflation then, because if people don't have a job, their thought is, well, that means they're not making money to go out and spend and create more inflation. Okay. That's how they look at it. It's really a poor way to handle it, in my opinion, from the way that the whole system works, but that's how it works. Okay. You got to put people out of job to get inflation down, rather than doing the other things that would really get inflation down, like energy sector, not letting institutional companies come in and buy residential real estate. How about those sorts of things? But anyway, I digress. Housing market at a turning point. So we see that CoreLogic and some other like Case Shiller see that basically, we see prices gradually going up at the beginning of this year through now. Okay. And we're going to see, and actually they upped their estimates countrywide that were, let's see, where is it here? I just saw okay. Yeah. CoreLogic forecasts that home prices will rise 0.8% in April and 4.6% and the year going forward, 4.6% rise in equity and prices, which is an upward revision from 3.7% in February's report. So they're seeing that housing market has, again, bottomed out end of last year for sure. Interest rates were over 7%. That killed everything. But now we're seeing that rates have been down, that they're seeing an increase in purchases, seeing an increase in what's going on in pricing for homes. We're seeing that in our area. Now, here, if you look at Mortgage News Daily for today's rates, you're going to see that the rates did drop a little bit because of what's going on with inflation. I'm going to talk about that in just a second. These are always what you're going to see on the mainstream media is typically going to be higher than what you're going to see when you deal with a mortgage broker, because a lot of this is just dependent on pricing and stuff. So, again, we had people just recently went under contract again, and close deals in the mid fives, and that's without buying down rates. So, things are definitely better than what you read about in the news. Some of it again is lazy reporting, lagging stuff, the Fed being behind the 8 ball, and it hurts everybody's bottom line, but that's just the nature of the beast. But anyway, here's why I wanted to here's what I wanted to show you as far as what I'm excited about. So this is kind of a crude way of looking at it here, but this is just consumer price index. This shows the year over year inflationary numbers and month over month for April of 2023. So year over year to be April of 2022, when this whole mess started with the interest rates going crazy. And then we ended up with all these inflationary factors, right? So the headline number it is down, okay, and inflation is down 4.9% from 5%. The core inflation, which strips out gas and food, because that core CPI is stuff that the Fed can't control, like how much oil OPEC is pumping out, and whether or not there's going to be a bad crop in food. Okay, so but that's down year over year 5.5% from 5.6%. Shelter costs, as I always point out, is 43% of the core inflation. That is dropped. Again, it hasn't dropped as much as we had liked, because they jumbled up these BLS numbers. And also a couple other things here that I want to point out. Used cars, we see this year over year minus of 6.6%. Used cars month over month, though, they've gone up 4.4%. So the used car thing is kind of funny, because that was something that wasn't necessarily in the calculations on a lot of this stuff. So that's thrown a wrench in things. And then insurance, we see that with insurance, like for instance, people had wrecks last year with vehicles, and what happened? They, put in a claim, and things cost more for the insurance companies to cover, right? For steel costs more, and those sorts of things. Last year, when inflation was sky high, and all the other parts cost more for the repairs. So this was another huge inflationary factor. Okay, so there's that. And then I wanted to show you, let's see, the shelter cost that we've been talking about that is cresting. When we look at this April of last year versus where we've been, you can see how those numbers are higher. Okay, so this is inflation, and then our rates go with inflation. So we can see where we were last year in April at 0.50. Now that, we've gone through all this, these, we told you these are going to be tough months. Okay. And Barry from MBS Highway had explained last year, these were all going to be high interest rate months because of the inflation being so high. But now we see this huge drop off here. Okay. So we saw the dip in rates from over 7, and now, on the news, you're going to hear they're in the 6s. Again, I'm seeing people getting them in the mid 5s. And that's not necessarily with the best credit in the world. But April year over year is down, okay, by 8 points. Okay. So as this goes down, we're going to see, again, everything lags, got to look at year over year numbers. And then whatever was being reported, like what was reported yesterday on May 10th was where we were in April. Okay. So as we go along, those numbers are going to continue to go down. Inflation continues to go down, which means interest rates, mortgage interest rates will continue to go down. Even if the Fed's fund rate continues to rise, which they're alluding to the fact that they're going to have a pause soon. Who knows how soon it's going to be? They could be raising the Fed's fund rate for another, 2-3 months or whatever. But I think this summer we're going to see, where we're reporting mortgage interest rates. I think we're going to be in the low 5s or high 4s by summer or end of summer. That's what I think is going to happen based on what I just showed you on that chart, because those shelter costs, all that information is going to catch up as far as shelter costs, even with all the jumbling around of the BLS numbers and, the used car stuff and the insurance stuff that's come into play on this, inflationary factors. It is trending down. Inflation is trending down, which means your rates are going to trend down. And in a recession, okay, which I'm sure, we've already, had a couple consecutive months of negative GDP growth before, but they're projecting that we're going to be in another recession by the end of the year. And whenever that happens, it's, the interest rates always go down, and it's always good for the jobs market. It's always good for the mortgage and real estate market. So because interest rates drop, all right, so equity will go up. The only time in history that we saw where mortgage equity didn't go up was really overall in the 2008 crash. Okay. So, what brought on all this inflation? The extra COVID spending, the pent up demand when things shut down and things were, stopped being produced. And then you had a run on products that people wanted that they couldn't get. So, once those, things just weren't happening for a while, price shot up to start reproducing them and get them out there. Also, we're not energy independent right now. That's a whole nother factor. And then you had all these institutional buyers coming into the residential real estate market, flipping homes, who are now, cutting back on their employees and their acquisitions, with companies like BlackRock and Open Door, OfferPad, all these companies that are out there. We're seeing their business model change. They're laying off a ton of people. Whereas before, we had people in the industry. Oh, are they going to replace realtors? No. They come and go. They're basically wholesalers. We've always had wholesalers. They come and go. It's a fad thing. Even Zillow tried to do that and didn't last very long. And then we had these institutional, companies coming in and just jacking up the rents and stuff. So, we see that, all those inflationary factors, a lot of it ended up in shelter costs. And now we see this huge drop in shelter costs. Energy prices are still up. And it's not to say that there won't be inflation, but we're seeing inflation drop off due to those shelter costs and the bringing back of the supply chains and stuff like that. So, again, anything could shift at any moment. We head into World War III, things could change, but that's where we are right now. So, guys, I'm going to be making a couple other videos here soon. I don't want to include it in this one, but I'm going to be making a couple other videos, and I'm going to be showing you um, a couple other people's take on some of these inflationary factors and stuff. Also, what you would have lost out on if you listen to the mainstream media. I'm going to show you a great little video on that here coming up. So keep an eye on our YouTube channel, Mincola Group, and our Facebook and Instagram, and I'll be putting those out soon here. But right now in the Phoenix area, we have a super strong, real estate sellers market. We are at a 152.7 on the Cromford Market Index. Anything over 110 on the index is a seller's market. So that's been ticking up just in the last few days. It's been ticking up regularly. Okay. Now we are in a busy season. We are in a busy season for sure. Spring, early summer for us. Our kids are back in school around the beginning of August. So, or by mid-August at the latest for most places. Our demand has been, going up or staying steady. Again, a lot of that does have to do with rates. A lot of people are sitting on the sidelines waiting, or they just can't afford to. I tell people, if you can afford to buy now, get the good price, because prices are gradually going up as we go into the busy season and as rates do trend down. Interest rates trend down. They are trending down. So that, and over the summer, if what I think is going to happen is going to happen, we are going to see a whole nother flood of people. Just think about it. If you go from, we went from 7% down to around 6 or in the high fives, mid fives, that, 1 percentage point difference lower brings in 5 million more home buyers, 5 million more home buyers across the country. So, we're one of the hottest markets always in the country. One of the hottest always in the country here in the Phoenix, greater Phoenix area. Our supply is also very low. I checked it this morning. It was just over 12,000, all property types, 12,000 homes for sale that are active. That's not a lot. Again, a true balance market and our market should be around 30,000 in inventory. That's a healthy inventory level. A year and a half ago during the anomaly, or just over a year ago, during the anomaly times, we were, down anywhere from around 5,000 or 6,000 up to maybe 8,000. So we're not too far off from that. We do have a little bit more supply. But again, real new inventory, really, if you look at the supply index here, is super low. Really, if we're in balance, the demand and the supply numbers would be the same. Or on the market index overall, we would be, at 100 if we were in a balanced market. Between 90 and 110 is kind of that balanced range. Below 90, we're in a buyer's market. Over 110, we're in a seller's market. So right now, 152.7, we're in a seller's market. So guys, that's really all I have for you right now, but keep an eye out. And I'll get those other videos out probably either later today or by tomorrow. And those couple other videos. And if you're on our emailing list, I will definitely get you those sent out also by the end of the week. So guys, if you have any questions at all, always feel free to reach out to us here. It's at 480-788-8569, or you can check us out at mincolahomes.com or mincolagroup.com, or email us at home@mincolagroup.com. Guys, we'll talk to you next time. Thanks.